A very good afternoon, everybody. It's a pleasure to host Hardik Shah sir. Today's topic of Stalwart series is integrating sustainability in investment decision. We are going to learn A to Z about sustainability and investing, sustainable investing. Hardik sir himself has a in intensive background in this domain. Hardik sir has spent more than 15 years and is currently serving as head of sustainable investing at DSP BlackRock Mutual Fund. We basically are privileged to host Hardik sir. Thank you so much, sir, for agreeing to share your insights, your learnings with our candidates. The session is being attended by our FinBridge and FinPlus students. This is our professional certification program. With your permission, we would be posting recording of this session on our YouTube channel as well for rest of the crowd to learn and follow. Over to you, Hardik sir.
Thank you, Shailesh, and hello everyone. Good afternoon to all of you. I hope you're able to hear and see me fine.
Yes,
All
sir.
right, perfect. Thank you. Um, so as Shailesh was saying, I have been in the ESG or sustainable investing space for over 15 years now. I'll maybe spend a couple of minutes about my background before I get into like the agenda for today. I'm an engineer by graduation and then a master's in finance and a CFA. So I've basically uh, in a way switched domains over time, and sustainability is something that is a keen interest that I have in, as well as a passion for me. So almost like 12, 13 years back now, when somebody first told me, do you want to do ESG research? And I'm like, what is that? And that's when people kind of explain to me that, okay, you kind of look at financial analysis, but from an environmental, social, and governance lens. And I'm like, that's fantastic because I can merge both of my passions, which is more working closer in the capital markets or the field of finance, and also not kind of ignore sustainability while doing so. So that's kind of how I've got into this space. I've done in the last about 12, 13 years, everything, maybe last 15 years now, everything from climate consulting to ESG research and ratings since 2017, I've been mostly on the asset management side, helping portfolio managers and analysts understand sustainability risks, understand sustainability opportunities, and integrate them into their thinking as an analyst or a portfolio manager, right? So in some cases, it's easier and it will kind of come off when I take you through a couple of case studies, but in some cases, it's easier to kind of translate sustainability of issues into financial issues. In other cases, it's a little bit more qualitative in nature. And I think over time, as you do this, you will kind of learn how to uh, somehow quantify this in your kind of thinking as well as decision making. Um, with that, let's dive into this. So today's topic, what I want to kind of leave you guys with is a decent understanding of how do you integrate sustainability issues, whether it's risk or opportunities. So I'm trying to kind of present both angles to you into your investment decisions. So if you are an equity analyst, if you're a portfolio manager, and I think a lot of my uh, talking points or a lot of my thoughts will be more from that perspective. Uh, uh, so first question is, should you even worry about ESG or sustainability issues, right? That's kind of number one. If yes, how do you kind of do that? That's number two. So that is the whole idea of today's discussion, is that's how I'll kind of try and walk you through different things. I've given a short bio. I'll skip through this. We've discussed this a little bit. I mean, most of you might be familiar with DSP asset managers, but a little bit of snapshot about us. So I'm currently part of the equity investment team at DSP Asset Managers. We have, as a group, a long history of operating in the financial markets. Very specifically, DSP Asset Managers. We have uh, primarily dealing in the public equities and public fixed income space, essentially public markets. We have a wide variety of funds. As you can see on the screen, about 75% of our AUM is in equities, and the rest is split between fixed income and other assets. Um, like I was saying, a lot of my thoughts will be from the equity perspective, but in case any of you are more interested in and knowing more about how do you look at it from a fixed income or a bond perspective, I'm happy to share some thoughts, but otherwise I'll stick to the equity perspective here. Um, in terms of let's kind of dive in, right? So I think the first question that anybody who is not a practitioner in this space would ask is like, what exactly, let me understand what is ESG investing, what is sustainable investing, what do you kind of, are there different ways to do the same thing? If not, what is the right way, right? So maybe let's tackle the 101, right? The question here. Now, the UNPRI, the Principles for Responsible Investment. Now, think of this as a global body who is getting together investors, both asset owners, they're basically the providers of capital, and asset managers, the managers of capital together, and aligning their thought process on responsible investing or sustainable investing. There are different terms that are used here. Uh, this all started almost 25 years back, maybe 30 years back now, as this socially responsible investing, or SRI kind of movement, right? So in the late 90s, early 2000s, there was a group of long-term investors who said, I don't want my investors to have investments to basically lead to negative impacts on the society. Hence, they said, okay, I will not invest in companies that manufacture tobacco products. I will not invest in companies that manufacture alcohol products, and so on and so forth. So I think the broad category that we know as sin goods, these investors said, we don't want our investments to negative social societal impact, and hence I will exclude them. That's how the whole, uh, I would say, early days of the ESG or responsible investing started. But what you see in practice today, not just in India, but across the world, is more on the right hand side of this chart, which basically says responsible investment. Now, here, what is very important to understand, and I think it's important that we kind of get this clear upfront, because when you ask anybody, what do you think is ESG investing or responsible investing, everybody has their own view, right? Somebody might say, okay, it means I cannot invest in weapons, I cannot invest in tobacco, alcohol. Yes, that is one way to do it. Somebody else might say, I will only invest in companies that are more sustainable businesses, right? So whether it's renewable energy or water kind of treatment and whatnot, that is another way to do things. And there's a couple of other ways that we'll see on the next slide. But what is very important is the whole purpose or the goal of responsible investing is essentially very closely aligned with the normal way of investing that you and I know, which is basically we want to get the best risk-adjusted returns for our clients and portfolios. Now, in this process, if any environmental, social, or governance topic becomes more financially material, then you as a prudent analyst, you as a prudent portfolio manager should be paying attention to that and factoring that into your investment analysis, right? So that's the whole purpose of responsible investing. In terms of how what are different ways of incorporating them, I think what you see on your screen are the broad, I would say, six different approaches, and I think it's very important to understand that none of them are right or wrong, right? It's depending on your client's goal or your goal, you could choose one or more of these approaches. So let's start off with the right hand side of the screen. The three screening approaches. So either you could say, I will positively screen companies, meaning I'll pick companies which are somewhat by some measure sustainable, right? Whether it's an ESG score or a rating, whether it's some particular metric that you care more for, let's say carbon emissions and so on. I will rank companies and then pick up the best in class ones and create a portfolio of that. So that's one way to do it. Negative screening and norms-based screening are more exclusionary in nature, wherein you're saying either because of religious reasons or because of other kind of, let's say, what we talked about earlier, like negative impacts to the society, I would screen out certain type of companies. So sin sectors, tobacco, gambling, so on and so forth, or companies that are violating human right norms or child labor norms and so on and so forth. I don't care how good return potential these companies have, I would not invest in them. So that's kind of the approach investors would take on the screening side of things. On your left top left side, you have active ownership. Now, this is something that a lot of you might be familiar with, right? Most of you must have heard of proxy voting. Now, that's one way in which we as active shareholders kind of convey our preferences to the company's management. So, proxy voting forms a part of active ownership. Another way, which is very popular in the ESG circles to kind of, in a way, do active ownership is through engagement. So, when we meet managements, we would convey certain areas where we think management could do better vis-a-vis peers. So it could be maybe we've looked at your carbon footprint and your peer competitors' carbon footprint. They are much more carbon efficient, meaning they're generating the same output, whether it's in terms of tons of products or whether it's in terms of dollars. They're generating the same output, but with a much lower carbon emissions, right? So why can't you kind of improve and kind of align to that? Maybe the diversity levels in some of your peer industry is maybe 50%, whereas yours is only 20% in terms of gender diversity. Can you do better, and so on and so forth? So there are topics around uh, still financially material, but related to environmental, social, or governance that we would bring in these management discussions and then convey to them what investor preferences are. In some cases, it's a low-hanging fruit and management can easily tackle these issues. In other cases, it could be something that they will take multiple years to kind of implement and improve. So I think it depends on the topic or the ask that investors have, but that's a very popular way in which you could convey your beliefs. Thematic investing, I think that's the name says it all. You pick up a couple of themes, one theme, and then invest. Like renewable energy is something that is very, very popular and hot in India in the last few years. It could be affordable housing or climate adaptation and so on and so forth. Last but certainly not the least, the ESG integration piece, like on the bottom left. This is by far the most popular approach, I would say, taken by mainstream investors across the globe, whether it's Asia, Europe, or the US. This is the most popular approach. And the same thing is what we talked about in the last slide, where we basically say, let's quantify financially material ESG factors and then factor them into our thinking, right? Uh, don't get me wrong. I'm not saying that every single decision of buy or sell should be influenced by ESG. But if there are multiple inputs that you are taking while making that decision, ESG or material ESG risk and opportunity should be one of those inputs. So that is how typically you see most mainstream asset managers in India as well as globally kind of approach their ESG factors. Now, the logical next question is why should I care, right? I just care about returns. Why should I care about ESG or sustainability? I'm not here to save the world. I'm just here to make money for my clients, right? And that's a very valid question. The reason why you should care is a lot of these factors have over time become more and more financially material, right? So let's take this example on this slide. Uh, Both company level factors, like let's say circularity. Now, is the company able to recycle some of its materials or not? That has regulatory implications. Is the company able to give good quality products and services to its clients? If not, there will be essentially product recalls that you'll have to do, maybe say in the case of automobile sector or even pharmaceutical, or you could have negative media perception because of poor service quality that we've seen for some of the brands in India as well. All of these issues are either E or S or G, but they have direct impact on margins. They have direct impact on your ability to grow sales as well as eventually your profitability. When you talk about macro factors, like let's say climate change, for example, right? Now, these will not directly impact a single company, but surely through the either banking system impacts or cost of capital variances and so on and so forth will have an impact, and we'll see that as we progress through the discussion. So why should you care? Because these issues are becoming more and more financially material, and as a fiduciary, as a in a way a steward of assets of your clients and maybe your own money. These things should not be ignored, because you could then basically end up in a situation where a company is actually on the wrong side of managing some of these topics, and essentially you see a drawdown or a change in valuations leading to basically loss, right, for you as an investor. Another example, and this is more specific here, on the left hand side essentially is your equation for calculating expected returns. Now, how does all of these things in the center impact, or why should they impact, right? So these are all macro climate factors. I've just picked one topic from the environmental pillar, which is climate change. Now, taking a couple of quick examples here. Now, water shortages. Now, this is something that historically for a country like India, especially a very, very huge risk. Because India is a very, very water stressed geography, right? We are, given our population, given our growth, we have very, very quickly depleted our groundwater resources. And because of climate change and erratic weather patterns, rainfall is no longer as dependent as it was maybe a couple of decades back. So because of this, they will definitely have a straight away impact on both agriculture, because India is essentially still a largely dependent on agriculture. India's GDP is about 20%, 18% dependent on agriculture and forestry. But more importantly, the industrial use of water is also very, very critical. Now imagine how will a power plant generate power, like a thermal power plant, if there is no water, because you need a lot of water for cooling purposes in these factories. think about a beverage manufacturer, let's say one of your Coke or Pepsi's. If there is lack of water availability or limited water availability, how are they supposed to meet the increasing demand for their product sales? Because that's going to have a very direct impact on how much they can manufacture and eventually sell to the clients and so on and so forth. So these are like some examples, and I'll leave the rest for you to kind of look at later on. Just kind of trying to bring home the point that both macro and micro factors on ES and G, and I'll focus largely on ENS because G is something that has been around for a while, and everybody's kind of familiar with how to look at corporate governance issues and so on and so forth. So a lot of my examples will be on ENS, but I'm happy to give a G example if there's interest on the Q&A side. Kind of tagging along with the kind of climate change theme, what you see on this chart is essentially uh, average temperatures across the globe, and over time you will see here specifically in India. Almost two-thirds or more of the country is actually going to be really, really hot to live and thrive in. So if that's kind of a situation, if global warming continues to worsen as it is currently doing, uh, imagine how will you do activities like agriculture, right? How will you do activities like construction and infrastructure development and so on and so forth? Because physically it's going to be very, very difficult to stay out. Then you might want to maybe have to switch into models like maybe constructing stuff in the night like that's happening in the Middle East because it's just too hot in the day to do so. It will have impact on global labor productivity. It will have impact on agricultural productivity, and I think in general, it will also cause mass migration. Uh, I'll probably just focus on one chart here on this on the left hand side. This basically chart shows the trajectory since the 1980s until recently of economic losses from natural catastrophes in India. Right, this is India specific data in USD billion, and you can clearly see a trend that um, there is both more frequent natural catastrophes, and this could be anything from floods, droughts, earthquakes, and so on. Obviously, not everything is driven by climate change, but that is very clear research that shows that a lot of these erratic weather patterns are being accelerated due to climate change. So you're clearly seeing financial impact play out. Now, if you're looking to invest in an insurance, let's say a property and casualty insurance company or even a life insurance company, you would want to be wary about how are they factoring these risks like climate change, because that's going to have a very direct impact on how many claims they'll have to settle in the future. And then if obviously the probability of default or probability of any event happening will keep changing as well as the weather worsens and erratic weather keeps happening. Um, Not everything is about risk and bad things. Now, there's also opportunities, and I'll talk more about this in one of the case studies. But what you see here is the number of countries which have net zero carbon commitments. Now, what does this mean? This means that countries are saying that we will basically not emit net new carbon emissions or greenhouse gas emissions in the atmosphere by a certain year. Now, for different countries, the year is different. So globally, I think most countries are targeting 2050 as the year by when they will get to net zero as an economy. In the India specific target is 2070, China is 2060. So depending on the countries, you might have a different deadline. But the trend is very clear that everybody wants to decarbonize their businesses and eventually decarbonize their economy. And when I say that, what it essentially means is not necessarily stop producing or stop growing, but do that in a more sustainable manner. So if you are, let's say, a cement company and you are trying to produce cement through your usual process, maybe can you use alternative materials? Can you use alternative sources of energy like renewable energy and reduce the carbon impact of your cement production? So it's not saying that stop growing and stop kind of uh, producing more or let's say growing as an economy. It's just saying do it more sustainably. What you see on the bottom of this slide is India specific targets, right? So India as a country has emission intensity reduction targets of 45% versus 2005 levels. This is basically saying tons of carbon per, let's say, million dollars of GDP. Basically, this is in units of GDP. We have a very clear target of renewable capacity expansion. So by 2030, the government is essentially aiming for about 50% of the electric capacity to be from non-fossil fuels. So this could be mostly renewable, but in some cases nuclear power as well. So there are like clear policy headwinds, tailwinds, whatever way you say it, which will drive the whole economy in a low carbon future. So there are opportunities that will come out of this as well. I'll just pause here for a bit to see if there are any kind of burning questions, Elish, before we move ahead.
Yes, yes, yes. I do have a couple of questions on chat, and I myself have a lot of questions. So if we can please move to slide number 6.
Sure. Yeah.
So on this, so the first thing which you said, incorporating ESG factors through either screening. So which means you basically, while filtering stocks or idea generation, you're leaving out companies based on a certain quantified score, or how does that work? Because it's a qualitative data point, so you must have a list of factors which you eventually weigh in into to come up with some sort of a cutoff score for a ESG company to have to be able to be eligible in the investable universe kind of a thing.
Correct. Yeah. So I think on the positive screening, that is typically how people would work. So there's an ESG score, whether it is from a third party rating agency, and there are quite a few in the market that will provide you a rating, or it could be your own in-house view. So let's say I just hypothetically DSP feels carbon emissions is a key factor, right? And I want to kind of only invest in companies that are carbon efficient. Then I would basically rank the whole universe based on their carbon intensity. So let's say tons of carbon produced per, let's say, ₹1 million or $1 million of revenue generated, and then say, okay, I'm just going to screen out or only pick the top quartile. Like that is one way to narrow down the universe. That's what you do, typically do in the positive screening bit. It could be a broad ESG rating or a specific metric. On the negative screening, I think it's more, I would say, based on the product involvement or the business involvement of things. So if you are a some say this is mostly true for the European clients, but if some of the European clients will say, I will not want to do anything with tobacco. Now, it could be a tobacco manufacturer, let's say like ITC, that I don't want to invest in a cigarette manufacturer. It could be a retailer as well who sells cigarettes, like a 7-Eleven, for example, right? So then that's like the most strictest form of exclusion. Others would say, I'm only concerned about manufacturing. I'm not concerned about retail. Because if you don't manufacture, nobody's going to sell that, right? So there are different kind of levers that people play around with when you do negative screening. And there's also an angle of revenue exposure. So sometimes what happens is when you're looking at
Percentage
large,
contribution.
yeah, so large conglomerates, right? They might have businesses in different sectors, including weapons, tobacco, alcohol, whatever. But if that is not more than 10% of their revenue, then some investors say we are fine. So a lot of this is not driven by us asset managers. It's actually driven by our clients who are giving us money. So it's more on their uh, beliefs rather than our own beliefs, right? Because I might feel tobacco is bad because I don't smoke, but not necessarily all my clients or the mutual fund unit holders feel the same way, right? So I can't necessarily impose my personal views on the investments. It's more of sometimes there are large institutional clients that we cater to, and they say that, okay, we want you to kind of exclude certain sectors, and that's how we would typically do.
Got it, sir. Thank you so much for that answer. So I think we are pretty clear on the screening part. We get a broad level idea. Now coming to the active ownership part, like a lot of corporates engage into. So in India, we have a CSR thing, right? So if you
Mhm.
are a profitable business, there's I think 2.5% of your profits need to be compulsorily spent on CSR activities. So in that way, active ownership through corporate engagements in social initiatives is anyways happening. So does that make all
Mhm.
Indian companies eligible for the active ownership angle, or how does that work?
No, no, no. So active when we say active ownership is essentially, see, we are shareholders, right? Equity shareholders. We are part owners of the company, and we can either be okay, just buy the shares and forget about it. Let management do what they want to do, and like hope for a growth over time in your kind of investment, or you could basically actively engage with the management and maybe convey certain preferences that you want them to kind of change, right? So sometimes, okay, why don't you expand in foreign markets? That's how typically some of the analysts would talk to them. On the ESG side, it's more of like the examples that I was giving earlier. Your diversity ratios are really bad. You don't have more women on the board, or you don't have more women in the executive team. What are you doing to improve your diversity? What are you doing to reduce your carbon emissions, and so on and so forth? So I think that's what we mean by active ownership, not necessarily CSR spend. I mean, the way I see CSR spend is obviously it causes positive impact, but it is mandated. It's more a compliance thing, right? You don't have a choice. You have to do it. Here, it's like There could be areas where you have a choice to do or not to do it, but if you're thinking long term and if it's going to benefit you as a brand or as a company, then you might want to kind of push the company in that direction again with the goal of long term, let's say, sustainability of cash flows and returns eventually.
Understood, sir. Thank you so much. Now, when it comes to integrating ESG in valuation, now there I have a technical question.
Mhm.
Um, Now, a simple approach of valuation is through a DCF, right? So you
Right.
forecast the cash flows and then you discount it based on certain risk premium added to the risk-free rates to be able to get the ideal valuation which you hope that stock to be of value for. Now, when it
Mhm.
comes to these ESG factors, do these ESG factors impact the forecasted cash flows when you are conducting valuations, or that is added as a additional risk premium into the discounting factor? How does that work
Uh,
when it comes to valuations?
actually, both. There are both ways you could do that. So I think, let's say, and I have one example later on in the case study. One that I'm going to talk about
Okay,
is
okay,
more where you integrate this into the cash flows as directly, right?
understood.
So, for example, there's going to be an additional cost, whether it is regulatory compliance or is a fine or a penalty that the company has to give because of
Mm,
mismanagement of one of the E or the S issues. Then
mm,
basically that's kind of straight away going into your DCF. In other cases, what will happen is because of let's take an example of a utility like a power generation company.
mm,
Now
mm.
you know that everybody's kind of going away from coal and towards renewable. If this
Right.
particular company says no, still I want to stick to coal-based power generation, I don't want to switch to renewable. What is very likely going to happen is the bankability of their projects future kind of credit that they want will become very, very difficult because you know that if the useful life of a thermal power plant is, let's say, 40 years, very likely much earlier than that, because of regulations or other factors, they will have to basically shut that plant down, right? Because of the amount of carbon pollution that that particular power plant does. So then in that case, that impacts your IRR and eventually your ability to kind of get financing for that. So in such situations, you might basically assume a higher cost of capital, or basically the discounting rate will be higher, and hence the valuation or the present value will be lower. And that's how you would assume some of the impacts. Yeah.
So is it safe to say when you incorporate a ESG lens into valuation, everything seems starts to seem overvalued at a point in time as compared to current valuation?
So so I think
Because both the
if you
factors
look.
are anyways working in a negative manner. I didn't really hear any positive factor when, let's say, you start doing something positive towards the society contribution, you start getting monetary benefits for the same.
Sure. So I think the two examples we spoke about, yes, they were more risk focused, so hence the valuation. So see, think of this more as ESG risks are, let's say, a new dimension of risk that you had not factored in before, right? So if you had factored in, it would be part of your valuation. You had not factored in, then there's, let's say, a new risk that you're factoring in. So obviously, on the post-integration valuation will be worse off than the pre-integration, but it's not always about risk. There's also an opportunity angle to it. Now, I'll give you an example, and we have the case study two talks about opportunity as well, but maybe let me take a social kind of example. Now, in a country like India, financial inclusion as a topic is very, very critical, right? The RBI has been promoting banks and other financial institutions to kind of do more financial inclusion in the long run. So let's say if 10 years back, there was a bank in India who was basically doing more on financial inclusion versus peers, right? So maybe having either some like smart apps and or maybe rural presence where they are essentially getting the underbanked and unbanked population of India in the tier two, tier three cities, maybe villages into the formal banking system, and they've done their groundwork. They have their own, let's say, brand recognition in that part of the world. So as and when, because of digitalization and because of, let's say, improving livelihoods, you get more and more business from that cohort. Who will you remember first, right? You'll remember the bank who was with you, let's say, 5 years back versus what's with you today. So your, let's say, ability to win business will be much higher if you had invested early on versus somebody who's like just because of compliance or, let's say, regulatory push trying to do it today. So that's one example. There's one more in the case study too that I'll talk about this as well.
Got it. I won't steal content from the next slides. I apologize for that.
Yeah.
One last question. When you started talking about carbon emission. So I was
Mhm.
reading an article yesterday on, challenges which India is going to face in future, according to one of the authors. And in that article, there is a line. I have it opened on my mobile because I usually don't remember the regulatory authority. So it says the European Carbon Border Adjustment Mechanism, CBAM, it is coming into force from 1st Jan 2026. Does
Yeah.
it seem to have any impact on your way of ESG investing?
It will have an impact to the extent the companies we invest in are exporting into Europe. So I think for those businesses which export their products to Europe, it will have an impact. Yes.
Got it, sir.
Yeah.
Fair enough, sir. I think there are a couple of questions from students. One of that question is, how do you evaluate carbon credits when it comes to businesses? Because the popularity of the same seems to be very much increasing.
Mhm. Sure. So, see, carbon credits essentially is there are different ways to let's say get those carbon credits. So, historically, what's been happening in a country like India is the voluntary carbon credit mechanism, right? There are until recently there was no regulation saying you have to reduce your carbon emissions, and whoever did that did so voluntarily and got those credits and then traded those credits in either the Indian market or the foreign market, right? That is how it kind of played out. What is the carbon credits? For those who are not familiar, it's essentially avoidance or reduction of 1 ton of carbon equivalent. Carbon, when we say, is basically carbon dioxide gas, which is one of the key greenhouse gases. You could reduce methane or any other greenhouse gas, but eventually the calculation always happens in equivalent of carbon emissions. So if you as a, let's say, us as DSP asset managers, right? We are not a manufacturing unit. We are basically a service company, a financial services company. We don't have a huge carbon footprint, but still we have offices where we use electricity. We have business travel that our staff does for conducting business. We probably would have some usage of certain products and services as well. So there is a carbon footprint that we have. If let's say our management says we want to go carbon neutral, right? So what will first we will do is estimate how much carbon emissions we cause in a year as a business. Then we buy those carbon credits from these companies which have generated them voluntarily and then offset our emissions to that. So essentially what we are saying is if I have produced 10 tons of carbon during the year, I'm going to buy 10 carbon credits to offset that, which means in the last year or whatever year I'm looking at, my net impact to the greenhouse gas emissions is zero. That is how typically carbon credits work. So why is it getting more and more interest? And I'll talk more about this in one of the case studies later, but is because now starting September 2026 in India, we have a regulated carbon credit trading scheme, which will be in force. And then there'll be more, I would say, uh, not voluntary but mandatory emission reductions that certain businesses will have to do. Currently, this is for 9 different sectors, and you guys can basically Google it. You will find which sectors those are, but like steel, cement, oil and gas, chloralkali, and so on and so forth. And industries or companies within this sector will have the first, I would say, direct impact. And then whatever carbon credits they generate will be traded amongst those sector companies as well. So I'll talk a little bit more about this later.
Perfect, sir. Thank you, sir. There are additional questions, but I guess we'll pace it out for the next break.
Sure. Sure, sure. So we looked at the why. Let me just spend maybe a couple of minutes on the how. I'll skip this slide. I think this is just our approach as DSP. Like, what are we doing? Maybe just one thing to highlight here is we are basically the two kind of features we have in our approach is ESG integration and active ownership. So if you recall back the slide 6, which had 6 different approaches, the two that we are actively using is ESG integration and active ownership. And very rare, let's say client specific separate accounts, we would do screening, but otherwise proactively, these are the two approaches we are doing. How does this kind of work in practice, right? I think just look at the 4 boxes on top. Um, we have a process in place. We have a proprietary framework to do ESG scoring or an ESG rating, right? For lack of a better word. So we do the ESG analysis of all the companies in our universe using our own framework that kind of turns out with, let's say, a score out of 100 or a 10, whatever the scale is. And we also identify the risks or opportunities, right? So is it that the company is managing all of their material ESG risks well? If the answer is yes, fantastic. We don't have to worry too much about it. But if there are gaps versus peers or gaps where we feel company could do better, That is something that we would note down, discuss with the analysts, right? What are these concerns? And not every single thing is a material concern, right? It could be five different things that the company could do better, but only one where maybe there is a more short term or a mid-term financial impact possible. So we would narrow down, prioritize the topics which we think are the most material, discuss that with the analysts. In some cases, analysts might say, I've already factored that into my model, so then maybe we don't want to change anything. In other cases, analysts might say, oh, this is something new that I had not thought about. Maybe how do you think this will play out? What time horizon? Will it be in the next 1 or 2 years, or will it be 5 years down the line? Because of time value of money, all of that impact will be very, very discounted. Like if something is going to happen 10 years down the line, good or bad, and in today's present value, it's not going to have a lot of impact, right? So we have those kind of discussions. In some cases, it might lead to setting up a meeting or a call with the company management to get more clarity, saying what are you doing on this or that. And in other cases, it would be just maybe a straightforward integration. But that is how the process works, and this is a continuous feedback loop as well. So sometimes the analysts or the portfolio managers would learn from an ESG person. Sometimes we learn from them as well. Like how do you? It's a kind of a, let's say, a co learning and an implementation process, rather than I have done this rating and you have to follow that rating. If you take that approach, I don't think it's going to fly much beyond a couple of companies here and there. So this is something to just kind of more, how does it play out in practice? Now let's get into an example of how do you assess if something is financially material or not, right? Here I've purposely taken an example of a social topic, because that's more like difficult to quantify. Environmental issues are much more easier to quantify. Now here, what kind of thinking do we do before determining if something is financially material? So here, what we're talking about, labor practices, right? Is labor practices a material issue, let's say for a manufacturing setup, right? Whether it is steel, cement, tire, whatever, right? That is how we are thinking about it. And all of this is industry specific. That's another important thing to note, that not every single environmental or social issue is relevant for every single sector. A very classic example would be carbon emissions, right? So carbon emissions, everybody will say climate change is important. Climate change is something that we have to tackle, but it's more important for utilities, for oil and gas, your steel and cement, where you are more carbon intensive or energy intensive in your production processes, whereas it's probably less important for a financial services sector or a bank. For a bank, maybe what's more important is what kind of uh, uh, financed emissions or investment emissions you have, right? So basically, let's say a bank is providing capital to a particular project. Is that project carbon intensive or not? Are you factoring that risk while you are doing that due diligence or not, right? That kind of stuff. So again, coming back to this materiality assessment, so as labor practices, like what kind of things you would look for, right? Do you have examples of materiality? What do I mean by this? Is there any existing or upcoming regulation that will force companies in this sector to kind of, let's say, be more is to pay more attention to this issue, right? The carbon credit example is classic, but the labor code that kind of was revised recently in India would have some degree of impact on certain sectors. Uh, are there examples of companies getting fined because of mismanagement of this, right? So you're trying to say, okay, what happens if company doesn't take care of this issue? Is it going to be no impact? Maybe some people might say this is a bad company, doesn't take care of its employees, or is it more than that? So you want to see examples within the sector, preferably, where if they have like mismanaged labor practice or practices of maybe not paid overtime wages and whatnot, what has happened? Has it led to strikes? Has it led to regulatory penalties and fines and so on and so forth? Then you look at what is going to be the area of impact. Is going to be like a revenue impact, or it's going to be a cost and eventually impact your bottom line, or it's just pure reputational in nature. The third column is, in my view, very, very important. What is going to be the probability of impact, or more importantly, the time horizon when the impact will play out, right? So if you as an investor are looking at like a 2 or 3 year time horizon for your investment, and something is going to play out in 10 years, you might just discount it heavily in terms of how do you factor that in. But if something could play out in the next 12 months, then that's something that you want to pay more and more attention to, right? So uh, uh, how the companies that have mismanaged this issue been impacted. And you could look at global examples as well as regional, preferably regional, because regulations and fines and penalties would vary. So if you have a similar case in US, it could lead to millions of dollars of, let's say, litigation expenses, but in India, it could be maybe much more smaller, right? So you'll have to contextualize that a little bit more. And then obviously, what kind of impacts your exposure? Like I was saying, right? Where do you operate now? Let's say a cement company in India, but also has operations in Europe and elsewhere, or a steel company has plants in Europe. The way they treat their employees there will have a very different implication if you kind of are found mismanaging that, right? If you don't pay overtime wages in Europe, you're going to kind of look at huge regulatory fines and penalties and so on and so forth. So that, like, these are some of the kind of things that will drive your thought process and eventually help you conclude whether something is financially material or not. And that's how you kind of go issue by issue and determine, right? This is just one example I wanted to provide. Perfect. Let me just grab some water before I dive into the case study. All right. So I've just kind of prepared two different case studies. The first one is talking about integrating environmental risk and more specifically climate risk. This is the DCF integration example. And the second case study is more about opportunities, right? So how do you look at a particular sector that you feel is going to be benefit from being, let's say, sustainable or having a sustainable product or service. The first one, let's basically think about an Indian cement manufacturer, right? All of its assets are in jurisdictions which are having either an existing carbon regulation or something that's going to come up in the next 12 months. So carbon emissions for this company is becoming a more and more financial material topic. Now, you as an analyst, you as an investor, when you're looking to kind of integrate this, how will you go about it? So let's look at the regulatory scenario. Now, in India, for example, as I was saying earlier, the carbon credit trading scheme is something that the government has already notified. September 2026 onwards, carbon basically trading or the scheme is basically in place, and then subsequently I think on a periodic basis you will be like, as a company that's part of this regulation, you will have to demonstrate compliance, and if you are not able to comply, you'll have to essentially buy carbon credits to meet that emission reduction requirement. Based on certain let's say experts that we've spoken to, I think that the estimated carbon price is about 1,000 rupees per ton, or roughly $10 US dollars per ton, and it could vary. Nobody knows, right? It's basically going to be market driven. Um, Now, for the company, very specifically, they have some initiatives to reduce carbon emissions, but hasn't, at least in the recent 3 4 year history, been able to demonstrate a fast enough reduction in carbon intensity. Now, when we talk about cement, it basically is tons of carbon emitted per ton of cement produced, right? That's the number we're talking about. So basically, the conclusion is the company is exposed to a carbon price or a carbon cost. Now, given that you know this, how did we go about the analysis, right, for this particular company? I think one very important thing is to set the baseline. Like in carbon credit term, baseline is basically the year which is your reference year, and you compare your, let's say, future emissions to that reference year. So if the reference year is, let's say, 2024, uh, your 2025 emissions should be, let's say, 3% lower than 24. 2026 should be 5% lower than 24, and so on and so forth. That's how typically the emission reduction targets are. Um, I'll just maybe spend a minute talking about what is scope 1 and 2 and scope 3 emissions. So this is more the way in which you categorize carbon emissions. So again, let's taking forward the example of a cement company. Scope 1 emissions is basically emissions due to energy use within your own operations, right? So let's say they use uh, coal or coke, or they say diesel or any other kind of fuel in their factories, burn them, and then whatever carbon emissions comes out of that, that is their scope 1 emissions. Scope 2 emissions largely deals with purchase electricity. So if you're purchasing electricity either from the grid or somewhere else, what are the carbon emissions affiliated to that? And scope 3 is essentially up and downstream your value chain, right? So for a cement company, basically all the raw materials they are procuring, that's your upstream emissions. And downstream is once the cement is produced, they go to distributors and then retailers and all the transport related emissions and so on for that. So that's how the carbon emissions or carbon accounting happens. For most cases thus far, we've seen scope 1 and 2 emissions are the ones that governments or other regulators have been using to set these emission reduction norms. So we looked at the scope 1 and 2 emissions for the past 3 years for this company. And so, like, try to basically find what is the trajectory, right? Is it reducing year on over year? Is it going to be increasing over year and whatnot? Now, the government, and this is public information, we could go and search this as well. The government essentially for each company which is part of this regulation has notified plant-wise expected emission intensity reduction, right? So plant 1 needs to reduce from, let's say, zero point 0.5 to 0.48. Plant 2 needs to reduce from zero point 0.6 to 0.55, and so on and so forth. So we looked at the whole plant-wise targets for this company, and then obviously we know the capacity of each plant, and then on a weighted average basis, what we basically came up with was uh, the company needs to reduce its greenhouse gas emissions intensity by 1.5%. That is the target, and this is year on year. So from 24 to 26, that's one, and then 26 to 20. So every year, 1.5% reduction is required. Now, based on our analysis of past emissions, it's basically flat. It's not reducing, it's not increasing as well, but it's flat. So let's say zero for sake of this discussion. So it has to go down by 1.5, but it's actually zero. That additional 1.5% of their total scope 1 and 2 is the exposure the company has, and then they'll have to buy carbon credits worth that much money. Now, the next question is, what is the price of the credit? So we just looked at different scenarios. So 1,000, 1,500, 2,000. In each of these scenarios, what happens to the profitability, or more specifically, the profit after tax. So based on our analysis, at 1,500, let's say carbon price, basically the company is looking at about 120 crores or 1,200 million rupees of carbon cost. And then based on their financial projections that we have, it's going to have about a 2.5, 3% impact on their financials. If the carbon cost is lower, the impact is lower. The carbon cost is higher, the impact will be higher. Now, one might say, okay, 3% or 10% is not really uh, too big, which I agree, but it's not too small either, right? You can't ignore it. Like this is at the PAT level. I'm not talking about at EBITDA level, this is at the PAT level. So it is big enough to pay attention to. So what will happen is there'll basically be an additional line item in your expenses, which will be carbon credit cost. And depending on what we feel is the right number, right? And every analyst will have their own opinion. I might feel 1,500 is the right number. You might feel 1,200 is the right number. That's how models are made. You would basically factor that in as a cost item into your expenses, and then eventually your PAT will be impacted. So hence, what this will do is essentially give you lower profit after tax, eventually lower cash flows, and hence a lower valuation with everything else being equal. So that's how this is going to impact the company's valuation. So that is the process we followed. That is how we came up with. This was one example. I'll just pause here to see if anybody has any questions before I move to the second.
I think this answers the question which you are referring to. How cash flows are adjusted for valuation purposes should there be a.
Correct.
So this is a case where, let's say, you are estimating the probable outflow for carbon credit purchases to go, let's say, neutral.
Mhm.
What if a business is engaging into renewable energy, let's say EVs, but let's say in short run it's actually beneficial, but in long run maybe rare earth metals getting depleted. How does that factor in as a positive factor or a negative factor, and how do you guys go about quantifying the same? Or not you guys per
Sure.
se, because you guys basically purchase the ESG scores from somewhere else, let's say. But then how do they incorporate in their ESG score methodology?
Sure. So I think, see, the way to think about these things is let's say overall, is there a positive impact or a negative impact? And any business, even if think about, let's say, a solar power plant, like on the face of it, you think solar is renewable, it's very, very good, there's no pollution at all. But the fact is that you will need a lot of materials to build the solar, let's say, cells and modules. At some point, at the end of their useful life, you'll have to dispose them off or recycle some of it. There is going to be a negative impact, right? So every single thing you do, I think very, very few items you will find is a pure positive impact. So the question is the negative impact offsetting the positive impact, or why is it vice versa? So that's how you would think about it. So when you think about electric vehicles, what is essentially electric vehicles helping us do? It is basically doing away with tailpipe emissions, right? So the air quality that you and I are seeing in Bombay in the last few weeks, it's really, really bad. Uh, if you have more and more electric vehicles on the road, you will, let's say, see less of the air pollution, the sulfur and nitrous oxide and the particulate matter and whatnot. Um, the other thing that the electric vehicles are giving us an opportunity to do, and I stress the word opportunity, because it's not a given, is if we are able to decarbonize the grid, right? So if you have more and more proportion of renewable energy in the grid, then essentially it's zero emissions or close to zero emissions in the use phase for electric vehicles. The fact today is still more than half of India's electricity production is through fossil fuels. So even if I have an EV today, and I'm kind of saying that I'm clean or green, it's not entirely true because the electricity that is generated is still largely fossil fuel as the base fuel for electricity generation. As time progresses and as India expands its renewable energy mix in the overall fuel energy generation mix, that will have a positive impact. So that's how you think about it. Now on the factor of like rare earth metals or maybe mining impact and whatnot, I mean, that's a fair point. I would agree. But when you think about climate change as a problem, I would say that's a bigger problem to solve versus depletion of some resources, right? I think as long as it's valuable enough, I think the companies will make sure they recycle it at the end life. At some point, you might have a regulation as well forcing companies to do, like you have the EPR, right? The extended producer responsibility. Right now, it's in plastic and some other sectors. At some point, you might see that in electronics and eventually EVs as well.
Got it, sir.
Yeah.
So you mentioned, I think the number which I saw, and I could be wrong, I apologize. But on the PPT, I noticed $22 billion is the AUM in within equity or overall funds for DSP asset managers.
Equity is about 23. Yeah. Overall is 30. Yeah.
Okay, so this entire 30, how much percentage of that chunk is ESG compliant?
I would not kind of when you say ESG compliant, I think like the immediate next question is what is your definition of ESG compliance, right? So the way DSP approaches this is, see, like I said, is ESG integration, right? So if anything is financially material, whether the fund is labeled as ESG fund or not, you
Right.
would pay attention to it. So that's the approach we are taking. So we don't have a labeled ESG fund in that sense, but we are basically producing an insight for one company that could be held in one fund or 10 funds. That insight is basically getting passed on to
So
all the
across all
relevant.
funds, irrespective, so you're basically following a company approach rather than a fund approach when it comes to
Correct,
ESG.
correct. Yeah, because see, there will be some funds where, let's say, we have foreign clients who are investors and they might want us to do more, so we might do extra in those funds in terms of engagement or some sort of sustainability reporting. But in terms of integration, it's basically a centralized approach. We would assess a company, find out the environmental, social governance risks and opportunities, and then that is basically being shared with the analysts, and then we have basically sector specific analysts. So that analyst would cover a company and then that would be in multiple funds as well.
Got it. And then I'm guessing these all would be large caps, owing to the, I guess, the nature of the investors who are trying to ask for this kind of data and ensuring, or rather, you as an organization trying to integrate ESG into the way of investing for DSP asset managers.
Yeah, so I think, see, some of this was investor driven for sure, but a lot of it is like proactive, right? Because you think about this, like if you take a step back, if I tell a portfolio manager, okay, why are you factoring in corporate governance risks, right? He will say because it matters. It matters to the way company generates profits. It matters to the way company is able to give returns to investors, and so on. So similarly, environmental and social topics, not all of them, but many of them are gradually becoming financially material. So it is more like the way I see this is more an enhancement of your investment analysis and portfolio construction rather than something that you're doing separately or specially to kind of save the world, right? That's the way you would want to think about it, right? When you're looking at only financial material topics. If I'm one fine day coming in saying, let's not invest in tobacco companies, that's going to be more a belief, whether it's religious or otherwise, based exclusion rather than any financially material reason to do that. But if I say the same thing for coal, there could be a financially material reason because everybody is decarbonizing soon, I mean, India for a number of years now has a coal kind of cess or a levy, the way, by whichever way you put it, and that is going to kind of keep rising as time progresses. It might not happen in the next 5 years, but we're talking about 10, 15 years time, definitely, very clearly the government has said that renewable energy is going to be the key focus area. So you will see less growth, like the growth in coal demand kind of plateauing and eventually declining. And hence, there's not just an environmental reason not to kind of support coal production or coal-based power generation. There's also a financial reason to do that. There could be standard asset risk that you see in certain businesses. So given all of these approaches, I think that's how you would want to think about it as an analyst or an investor. Like if this is material, I don't care whether it's tagged ESG or something else. I should pay attention to it. I should not be caught off guard saying, "अरे हमने ये तो देखा ही नहीं," right? We didn't think about this or we didn't evaluate this. If after evaluation you say maybe this is a smaller risk and I'm okay with taking that risk, that's your judgment or that's your call as an investor. But not paying attention to this, I think, is a huge blindsided risk that you're taking otherwise.
Got it, sir. Thank you so much, sir. One last question before, sir, I read about this. I could be wrong, but I read about this before COVID happened. The uh, zero carbon zero target was way before 2050, 2070, I guess. But then eventually, after COVID, these targets, the timelines were revised and then they were shifted with uh, how do I put it gently, with a very not so fixed stance of the government when it comes to seriousness of uh, enforcing ESG into the DNA of businesses, where the timelines keep on postponing. And with investors being very myopic in alpha generation in short term rather than being focused on these aspects, where do you see this domain growing further?
Mhm. And that's a fair question. I would probably point out the second point you made about investors' short-term focus as the biggest risk, in my opinion, rather than the former one. Now, Indian government has not changed its stance, right? So globally, as per the Paris Climate Agreement, which was enacted in December 2015, the target was to get to net zero by 2050, right? But it's not like an enforced thing for every single country has to get there by 2050, depending on your current state of play, depending on your growth needs. Every country has come up with their own kind of end deadline. So India has always been 2070. It's not flipped from 2050 to 2070. It's just because we said we are at an early stage of development, we will grow, hence we will emit more, but we will emit, let's say, relatively lesser for let's say, per million GDP generation, right? So that is what the 45% target we were talking about earlier. That's India's stance, and that's what a lot of the emerging countries has done as well, including China and Brazil. So I wouldn't say that's flip in that sense. In fact, I would be. I have a very, let's say, strong positive view from the regulatory perspective. I think uh, when you talk about corporate disclosures, now BRSR is something that's come into effect in the last few years, but already you see the top 1,000 companies by market cap disclosing at least minimum level of sustainability disclosures. That helps investors like us to go beyond large caps. Like earlier, we were talking about, are you only doing this for large caps? No, the answer is no. We do it across mid and small caps as well. Wherever we find the right data and right level of disclosure, we are able to build an opinion on whether a company is doing good, bad, or average in terms of their managing their ESG issues. So that disclosure regime was very, very helpful in us kind of expanding our universe versus just looking at the top 100 or top 200 kind of names. When you think about the push towards renewable energy, that is a huge, I'd say, central government backed initiative. This is something that they are very clearly seeing as the future, and that definitely helps growing not only the players who are there in this market, let's say the wind or the solar manufacturers, but also growing the whole ecosystem. You need evacuation, right? So the grid infrastructure providers, you will need consumptions on the corporate side. Now you have access to more renewable energy at an affordable price. And I think in most states in India today, actually purchasing renewable energy is cheaper than purchasing off the grid. So you will see a lot of corporates actually use this as a way to transition and also save costs. So it's not like if and or kind of a thing. You are basically getting a cleaner energy source. So you're reducing your carbon emissions and hence reducing your liability in some cases if you're a regulated kind
Contingent
of
liability in some
entity,
cases.
but also you're saving cost while doing so. It's kind of becoming a no-brainer as we speak today. So I think that the more concern, and I'll just maybe close that response with the last point I make is the short-term horizon, right? So if you say I just care for the next 6 months or 12 months, a lot of these ESG issues will not matter. Uh, but then you are again taking that risk. Now, for example, uh, let's say you're evaluating a real estate company, right? You're investing in a real estate company which has these seaside properties, right? So in Bombay, in cities like Bombay and elsewhere in the world, those are the premium properties, those are the prime locations. But if sea level rises, if there are more kind of flood-like events because of erratic weather patterns or storms, those are the properties that will be first impacted because like you're just at the edge of the sea, right? Uh, that will have a huge impact on the valuations as time goes by. So if that happens once in 2, 3 years, nobody blinks an eye, but it keeps happening twice or thrice every year. Why would I, as a millionaire, want to live in that kind of a situation, right? So you will start seeing an immediate and a significant drawdown in valuations of those properties. Now, you could choose to ignore that and say, like, this is not going to happen till 2050, or it could happen next year. Nobody knows, nobody can predict. Even the scientists have been proven wrong time and again in terms of the severity of how these events are playing out. A classic example, and this is already playing out in practice, is in California. Now, because of the wildfires every year, they're not only becoming more frequent but much more larger in scale. And because of that, a lot of insurance companies have either like increase the premium so high that it basically doesn't make sense to insure, or let's say, I will not insure your property if you're in this particular region. Now you have multi-million-dollar homes there with zero insurance and a wildfire risk. uh, as a new investor, I would probably not put my money there, right? Because if it goes down, it goes, and that's a straight away loss to me. Nobody's going to pay me for that. So these kind of examples will keep increasing as time progresses, even in this
Brilliant.
part of the world.
Brilliant, sir. Brilliant. Thank you so much, sir.
Fantastic. Let's move on to the next case study. And then this is where I want to kind of bring in the perspective of the renewable energy, right? So earlier we saw the renewable energy is something that the government is supporting as the future kind of energy in India. You have very, very strong regulatory support. Now, as a fund manager, if you're looking to invest, let's say in a solar module and cell manufacturer, I just wanted to kind of, I don't want to get into the numbers, right? I can't talk about company specificities, but as an analyst or as a fund manager, what kind of things you would want to look at before evaluating whether a particular company is worth investing or not. So that's what I want to kind of take you through as a part of this case study. Now, here, basically, this particular company, let's say hypothetical company we are talking about, is into both module manufacturing as well as cell, and then is going backward integration into ingot and wafer. So when you talk about a solar panel or a solar module, basically you start with silicon going into silicon ingots made into wafers. Wafers are combined into a cell, and then cells are combined to form a module. That's the whole life process. And as further you go back into this kind of value chain, it becomes more complicated and more expensive to kind of produce, right? So essentially, cost per capex per megawatt for a module is much lower than cell and much lower than ingot and wafer and so on and so forth. So it's more difficult to kind of backward integrate. But this company, for example, that you're evaluating has been able to do that and has plans to do more. Uh, in terms of regulatory landscape, like obviously the 2030 target that India has is 50% energy from non-fossil fuels, right? So primarily this is going to be done by solar. We looking at more than 200, I think almost close to 300 gigawatts of solar installation from about 110 that we have today. So almost a 3x increase in the next 5-year period. So you're looking at 35, 40 gigawatts installed every single year. The ALMM is basically the approved list of module manufacturers, and then there's similar list for cell manufacturers. This is the equivalent of a PLI, production link incentive scheme from the government, which is supporting this industry to grow and so on and so forth. From a regulatory perspective, very, very strong tailwind, right? Um, in terms of the competitive landscape, the early movers have been able to generate strong EBITDA margins and ROEs because of the demand supply mismatch. Right? There's a huge demand for renewable energy, and suppliers are basically scaling up as time progresses. Uh, there are concerns about overcapacity, especially in modules. And there's also the US tariff policy, which is playing a role because some of the players in this industry have been making supernormal profits by exporting to US because the price differential is huge, right? But now because of US tariffs and the source of the particular module being maybe is the cells coming from China and you're just kind of making the module in India, that kind of issues have been cropping up, making that a less lucrative area to export than earlier, right? So this is basically the competitive landscape. Um, what are going to be the growth drivers? Now we've talked about the 3 points on top. I think I would want to maybe focus on the chart on the bottom left here, right? So if you look at the FY25 energy mix or power mix of India, you're seeing about 45% is generated from coal, about 22% is solar, and the rest is like we say minute from hydro, wind, and so on and so forth. In 5 years' time, the essential expectation is that solar grows from 22% to almost 40%, right? And other renewable energies obviously grow, but essentially coal is going to be a smaller proportion of India's energy mix. Again, if you're able to kind of do as per plan. So there is very significant change, and this is not I'm talking about 20 years, I'm talking about 5, 6 years time frame from now on. This is the chart on the right basically just shows like roughly incremental demand. And I think in the current fiscal year, we've done more than 35, 40 gigawatts of solar installation. And on an average, I think you can look at 35, 40 gigawatts of installations per year going up to 2020, 2030, 2031. So you see a very strong demand kind of landscape. You see a very strong regulatory support. And if you look at all of these data points, you will feel, let's just buy every single solar module manufacturer that's out there in the listed space, right? Because everybody's going to make money. It's a big party. Um, Not necessarily so. What else do you want to look at, right? The chart on the start talking about the chart on the top left first, right? Now there is for the last year or so talk about oversupply from a modules perspective. Now any sector, any business which is very lucrative, you will see competition come in and eventually profits kind of plateau and eventually normalize, right? The super normal profits. So if you see here, as of FY24, the demand for the DC is basically direct current, right? That's the way you would typically evaluate the solar panel capacity. So in terms of gigawatts DC capacity, about 21 gigawatts is the demand, and the supply is shorter than that. And hence, all of these players who kind of scaled up in this market are already seeing order books full for the next 12 to 18 months, maybe in some cases 2 years as well. But as more and more capacity comes online, newer players come in or existing players expand capacity, I think in a year or two, you will start seeing overcapacity coming in. So I think by FY27, you'll see demand kind of steadying or plateauing around 50 gigawatts, but the supply kind of going almost up to 100 gigawatts. That's one concern you want to have in mind. The second is on the solar cell side. Now, a lot of the early movers are now kind of backward integrating and saying we'll manufacture cells as well in India, because again, that is a higher margin business versus just producing modules. There, I think this overcapacity will probably come much later in FY28, FY29. So until then, players who are already operating in this space will kind of enjoy say higher margins and higher profitability ratios, but at some point that will also kind of go away. What is very important, and I just wanted to kind of show this as a proxy here, is the supply of capital, right? So if you look at the key solar company IPOs that have come in the last, I'd say 12 to 15 months, there were buoyancy, the enthusiasm was much higher, let's say 6 months back to a year back versus it is today, right? So if you look at Premier Energies, Vari Energies, these IPOs were like oversubscribed massively. Even Vikram Solar, which was like in September, August or August this year, I believe. But when you look at the more recent ones like Satvik and MV, you see the enthusiasm kind of mellow down a little bit as well. Now, this is not to say that these companies are like bad companies or anything like that, but essentially, if you look at like these two charts in combination, what you're seeing is the competitiveness in this market is increasing. There's going to be an oversupply. So at some point, basically, what will happen is some smaller players or late entrants might be basically not be able to uh, uh, generate enough profits, or might have to sell at a cheaper cost to basically just stay in the market. They might either eventually shut down or might be bought over by some of the bigger players, and that is a risk. That is a real risk that is very likely to happen in the next 5 to 7 year time frame. Another thing to keep in mind is technology. also changes every 3 to 5 years. So it's not like one time you do capex and you're good for like 20 years time. In solar, both module and cell manufacturing, I think every 3 to 5 years you'll have to do some massive capex. So if you are a company which doesn't have strong cash flow generation, uh, it's going to be very, very difficult for you to raise money to kind of fund future expansion as well. So these are some things to keep in mind. Obviously, the tailwind is something that is real, but this is also something that is real. So when you are looking at a company, you want to basically figure out, is this company going to be one of the leaders which will survive and thrive? Let's say when we are at 29, 2030 or 2029, 2030, or is this going to be something that's eventually going to bleed and either kind of go bankrupt or be acquired by, say, cents to the dollar, right? So that is something to keep in mind. Um, so just five, six key factors I wanted to kind of highlight, right? When you are looking at this sector, uh, the ability to backward integrate, I think, will be very, very important. So if you are just a module manufacturer importing cells from China or elsewhere and just making modules, I think very soon that kind of business model will become less profitable or let's say go out of flavor. If you're able to backward integrate manufacture cells, you will not only, let's say, be less reliant or less exposed to like the cross-border tariffs and other issues, but also may be able to make more margins because you're manufacturing domestically and there are already regulations or let's say government preferences for domestically manufactured cells and modules. So you will be able to command that premium if you do so. Um, Barriers to entry are lowest when you go from module manufacturing to backward all the way to the ingot wafer. So if you have, you'll have more players in the module manufacturing because it's like lower capex per megawatt versus going back. So again, that's going to be a short-term play versus a long-term sustainable business model. We've already talked about technology enhancement and changes. Couple of other things that could change, like if you just go back one slide, couple of what will basically improve the demand, right? Supply is something that is already say committed, right? Some of this might not get funding, might not come online, but otherwise there's no there's no rocket science behind doing this. So if you have the funding, you should be able to kind of commission a plant. So what will change the demand landscape? I think there are two factors that I wanted to point out. One is this whole AI boom, right? So you need more data centers. Uh, Data centers are more energy guzzlers. Now, a lot of the large players globally, when you think about Meta, Amazon, Alphabet, these guys have uh, I think more short-term net zero or carbon neutrality targets. So they say we'll probably get carbon neutral by 2030, in some cases 2035, and so on and so forth. So any incremental data center capacity that they either put themselves or basically subscribe to, they would want that to be fueled by renewable energy because otherwise their global targets are in a mess. So you will see a lot of renewable energy demand coming in. I think there was some statistics basically said uh, about 11 or 12 gigawatt of data center capacity is coming up and you need about 25 gigawatt of solar modules. Now, why is this math like 1:2 roughly? The reason being data centers cannot afford to not receive power when the sun is down, right? So you then get into the space of what is known as BESS or battery energy storage systems or some sort of hybrid models. A lot of newer um, let's say bids that are being allotted by SECI, the solar energy kind of body, are basically for hybrid or round the clock power generation, where basically you are combining solar, wind, and battery storage to ensure that on 24/7 power is supplied and not only when the sun is shining, right? So there is opportunity for battery energy storage systems. There's opportunities for some of the renewable energy players that are operating in the solar space as well are also expanding into battery energy storage systems or green hydrogen. So there are, I would say, optionalities that could improve their cash flows. There are optionalities that could improve the demand for renewable energy in India beyond what is already projected. And these are something you want to keep in mind while kind of taking a decision. So I'll just stop here. I think this is what I wanted to talk about from the case study two perspective. Any questions?
Yes, sir. So I do have a couple of questions, and I think a student of ours actually has a very similar question, which I did in my mind. So the student is asking if coal demand eventually lowers,
Mhm.
there would actually be a positive impact on businesses which basically use coal as input. So because of the ESG enforcing, or
Mhm.
let's say integration and further markets and government and corporates accepting this as a new way of going about conducting businesses, such
Mhm.
things would have a positive impact on those businesses which use coal as input. So the question is, do you guys actually incorporate that as a positive impact into the valuation of the businesses?
That's a good one. So I think the way you think about it is like just ask the question first, like, why would the coal demand go down?
Hmm.
Right? Either coal becomes a costlier fuel, and there are like cheaper alternatives like natural gas or some like renewable energy. That could be one example. So in that scenario, the question kind of falls flat because it's going to be more expensive fuel to use. So you're not going to have cheaper coal, but expensive. Now, uh, the reason for being expensive doesn't necessarily mean demand supply mismatch, but it could be a regulatory a fine or a penalty, right? So for every ton of coal that you consume, you might have to pay, let's say, 1,000 rupees per ton extra. So it just becomes more costlier. The coal, India, for example, is going to supply you at still the same rate, but you'll have to pay government some cess, some duty, something. I mean, already some of it is already in play. It could just worsen as time goes by. The second thing is around if you're a small player, maybe having a smaller footprint, then maybe in a few for a few years you will have cost benefit, yes. But if you're a large enough player to be part of, let's say, the carbon credit trading scheme, you have to reduce your carbon emissions intensity over time, right? So using coal is not going to help you do that. So if you save some money in let's say procuring, let's say, relatively cheaper coal, you will probably spend much more in procuring carbon credits to offset that emission impact. So in very in short periods of time you could have, I'm not saying it's not possible, but if you're looking at more long term, this is not a sustainable business model, is what I would say.
Got it. That question was asked by Manas. Um, I have a follow-up question very much on the same lines, but with a different example. So the power
Mhm.
article which I was reading yesterday was talking about what happened in Pakistan with more and more, let's say, solar capacity being installed. The regional power manufacturers and distributors were no longer generating revenue, which eventually led to them increasing prices of their, power distribution, and which
Mhm.
eventually led people to further move away from these businesses, making these businesses eventually bankrupt. Now, this is an indirect cost of positive, sustainable way of living. Now, how do you incorporate, or do you at all incorporate this while evaluating such businesses?
So you're talking about, let's say, traditional energy generators going out of business because of renewable
Yeah.
energy.
Because of
Yeah,
they used to have economies of scale till date, right? National monopoly was always in their favor. But now that
right.
the scale eventually gradually coming down, that monopoly is making it basically against them, because now consumers moving out, the fixed cost of these businesses is very high. They have to increase their power prices.
Correct, correct. No, that is something like interestingly, I think a month back we were having a similar discussion when we were evaluating one of the companies as well. Like, what if the grid, basically the cost of renewable energy is already lower versus the what supplied from grid? What's stopping everybody to switch to, like, say, directly renewable energy, right? So I think that is a possibility, but not in the short term, because again, the grid infrastructure is not mature enough in India right now to for everybody to say, okay, I have a factory in a remote part of Maharashtra. I just want to procure renewable energy directly from a solar farm or a wind farm. And can I do it, right? So that is one concern, but at some point that will play out. Now, you bring up a very important point, and this is in the ESG world known as a risk of just transition, right? So there's a concept called just transition, which basically saying is in this pursuit of decarbonization or a more cleaner future from an environmental perspective, are you having a negative social impact,
Hmm.
right? So let's say hypothetically, and again, I don't want to kind of name a particular company here, but let's say if renewable energy becomes the primary fuel, let's say 80% of our grid is renewable energy power fuel, obviously coal demand is going to go down. As of today, there are lakhs, if not crores, of jobs or livelihoods associated with the coal industry. It's not just the people working for the mining company, it is also associated kind of, you will typically have company backed, let's say, townhouses or towns, right? Basically, around that, there'll be an ecosystem supplying food, beverages, other services to that. what if suddenly that mine closes down? All of these guys will lose livelihood. So that's a concern, and I think this is something that I think in India we are not necessarily factoring in, but some of the global investors are paying more attention to it. I think as time progresses and as basically the the deadline for coal comes more closer, you will start seeing this factored in by Indian investors as well. But the idea is that how do you reskill people within this industry to kind of or upskill to maybe help them work in alternative industries, right? A very classic example. Unfortunately I don't have that chart here, but if you look at India's energy map, and this is a very important discussion point. Uh, the coal belt is essentially the eastern states, right, in India, whether it's West Bengal, Orissa, Jharkhand, and so on. Whereas all of the renewable energy development, almost all of it, is happening in the western and southern states of India. When you look at solar, I think Gujarat and Rajasthan are the primary kind of states where a lot of the investments are happening. When you look at wind, it's the southern states in India. Now, what is happening with people who are living there is a double whammy. They are associated with an industry where it's basically a sunset industry. If not in 10 years, in 20 years' time, you'll see that industry basically slow down significantly from today. But and on the flip side, they're not benefiting or reaping the benefits of actually the renewable energy boom. So that's kind of the most vulnerable set of population, which I feel is we need to do. And when I say we, I think both government and the private sector need to be a part of it. I don't think individually private sector companies could do much to have an impact like a statewide impact. But those are the set of population which will be actually very at high risk of losing livelihoods because of this transition, right? So the very classic example playing right in our home, but that's something which is an important topic. As of now, that time horizon when that will happen is maybe 15, 20 years, maybe more in the future for a country like India. But whereas in Germany or in the UK, that is something that's already happening. So you're seeing investor action much more faster in that market versus currently in India.
Got it, sir. Got it, sir. Thank you. Sir, if you could please move to slide 16.
Sure.
Yeah, so you
Yeah.
talked about probability of impact. Obviously, this is the expected value which we are trying to compute here. Now, the probability, how do you actually go about computing it? There is no empirical evidence for the same. There is
There
no,
is none. Yeah. 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 So
there
I
is,
think sorry, continue. Yeah.
no, no, yeah, exactly. I was just concluding the question. How do you go
Yeah.
about computing the probability of the same?
Yeah, so I think the way there's no direct math to it. I'll be honest, right? So I think a lot of this analysis is both an art and a science. Right? That's the way I would want to put this. It's not like a straight math. Otherwise, like computers would have coded it, and there would be no need for people like me kind of doing using our judgment to analyze a particular company, right? So the way I would think about this is in terms of time horizons, right? So if something has uh, uh, an impact in the short term, I would probably give it higher probability or higher weight. So the way I would want to define this probabilities in terms of the weight or the importance I would give this issue. So let's say for a cement company, there are four material, environmental, social, or governance issues, right? So let's say carbon emissions or climate change is one of them. Labor practices is second. Health and safety could be third, and maybe corporate governance. Let's, for the sake of this discussion, assume these are the four. Now, are they equally important? The answer is no. Which is more important? That will depend on how we think the negative impact or the mismanagement of that could impact the company, right? If I feel if they manage labor practices badly, there's going to be a strike tomorrow, and there's going to be a immediate impact on the production, right? If the company has a history of labor strikes, or maybe there are strong labor unions, and this could actually backfire very badly, I would probably give labor practices a 30 or 40% weight in my analysis, right? Versus corporate governance and other things. So that's how you think about it, right? How much importance do you give to a particular topic versus something else?
So the sensitivity for the same is very high, right? Sensitivity for the, so if you change the probability from, let's say, a zero point 0.2 to zero point 0.3, things might change drastically when it comes to valuations of the business. Should at
That's
all
true.
that number be, something which moves a business by a huge amount. It may be a needle to us, but when it comes to valuation, it's like you're altogether moving a telescope just by 1 inch, you are altogether in a very different galaxy.
Correct, correct. No, you are right, and that's where the skill of the analyst comes into play, right? You've looked at the sector multiple times, you know companies, or you know what kind of drivers drive certain businesses, and that's essentially that's the art part of it. Like I don't, sorry, unfortunately I don't have a good formula to share saying, okay, this is how you do it. It's just I think on experience you'll kind of learn to do it, and that's the reason why it is still not a more accurate science like let's say accounting is, right? Like there are straighter ways to kind of generate ratios. There are obviously there are nuances in that as well, but it's still the accounting frameworks are much more standardized, whereas ESG frameworks are all over the place. So I don't see that as a problem because that will give us, let's say, an active manager. If we do our job well, we should be able to kind of identify risks better than peers, or maybe identify opportunities better than peers, and over time essentially outperform. But at this moment, I think there's no good way to kind of say that, okay, this is the right way to do it, essentially. Yeah.
Got it, sir. Got it. Fair enough. Thank you, sir. So you mentioned there are some BRSRS sustainability disclosures which have
Right.
started coming in. Can you talk a little bit more about that? Because I think we can
Sure.
incorporate that in our training content. That seems to be a very valuable content addition to our training program.
Sure. So as a part of the listing regulations, SEBI has basically mandated, as of now, it's about top 1,000 companies by market cap, right? To basically disclose sustainability information in the format which is known as BRSR, so Business Responsibility and Sustainability Reporting. This is a standard format. You can go to BSE or NSE website, and under company disclosures, you can find it. All the companies will basically publish that as a part of their standard disclosures. What this basically does is creates a set of comparable data points across industries, right? So right now the format is not sector specific. I think at some point in the future you will start seeing sector specific templates coming out as well. So if you're a steel company, these are the five extra things you would want to disclose on. But right now it is kind of a same set of parameters across industries. So this is the BRSR might be maybe a 4 or 5 year old framework, but there was earlier something known as BRR, a business responsibility
Hmm.
report. Just maybe a smaller version of the BRSR. So I think since 2012, 2013, that's why I kind of laud our regulator to be kind of very, very early in this kind of aspect. They have started kind of gradually nudging companies to start disclosing sustainability data. The reason I say this is very, very important is because, see, when you start publicly reporting some numbers, at some point you would say, I want to look good, right? I don't want to look bad versus peers. So it's an indirect way for companies to start paying more attention to some of these sustainability factors. Maybe in year one, my carbon data is really bad, which is fine. But in year two, I want to improve. In year three, I want to show improvement over time. So once this gets into public domain, people start in a way judging you based on what your performance is vis-a-vis peers. You would want to improve that. So in the long run, this has a positive impact on
Got it.
on the overall field
This
of
is
business.
annual disclosure or quarterly? How
Yes.
does it?
No, this is annual disclosure.
Annual disclosure. Got it, sir. There's one question from a student. So, I noticed in your professional journey, you've worked with MSCI in the past, and I think it is one of the ESG indexes provider as well. So,
Mhm.
which companies do typically provide ESG scores to you guys, where you basically, or not per se DSP, but let's say what are the typical names who typically provide this ESG score data based on a certain standard methodology? I know MSCI does, but I'm not really sure about their Indian coverages. But
Sure.
any other providers which you can share with the students?
Sure. So globally, the top two are MSCI and Sustainalytics, which is basically now part of Morningstar Group. These are the top two in terms of global ESG rating providers. They have more than 20 years of history, more or less. In terms of India market, these guys used to provide in the past ratings to Indian asset managers. But I think sometime in 2023, SEBI came up with a regulation for ESG rating providers which had certain compliance requirements. And I don't know everything in detail. I think I'll not comment too much on it, but essentially you need these global providers needed to have an India specific rating framework. So don't use the set of metrics that you rate, let's say, an Apple or a Google on to rate Infosys or TCS. So that is like in a crux, and then obviously there are other requirements as well. Due to this, a lot of these global players have decided not to kind of offer ESG ratings in the India market. So now from an India market perspective, and there might be more, but I know a couple of them which are the bigger ones. So I've seen CRISIL have an ESG rating offering, and some of the peers use them. There is SES. I think they were earlier known for like proxy voting and governance advisory, but they've also expanded into ESG ratings. And there's also ICRA. I think ICRA has a separate entity which does ESG data. So these are some of the names I have come across. There might be more out in the market, but these are like already, I would say, aligned with the SEBI requirements for ESG rating providers and are providing ratings. For us at DSP, we are basically using public data, the BRSR data, and other sustainability report data to in our own framework to kind of do this. In the past, we've used some of these data providers, but I think we found more merit in having our own framework.
Got it, sir. Um, Once. Right. So when it comes to ESG disciplinary or rather ESG discipline, which asset managers have been following it very rigorously all over world and maybe in India as well?
I think it will not be fair for me to comment on peers. Globally, I can talk about it, but India specific, I'll avoid.
Yeah.
You see, everybody has their own approaches, everybody has their own end goals, right? So, like I was saying on the slide, slide 6, which was like the different approaches, nothing is right or wrong. It depends on what
Yeah.
your clients are demanding of you. But globally, it's mostly the European asset managers, which are like, say, global best practice in terms of ESG approaches. Some of the popular names I would probably point out is Schroders, there is Robeco, there is Northern Trust Asset Management. I think that's an American one. These are the ones which have uh, had larger ESG teams. Legal and General is another one, Legal and General Investment Management. These are some of the more, I would say, leaders in this space. A lot of these people publish an annual responsible investing report or some sort of a sustainability report which talks about their approaches, examples, and so on. And that's publicly available. So if anybody is interested, you should look at some of their disclosures to then kind of get a sense of what kind of approaches they have, what kind of case studies they have, what benefits they see, and their investment team see as well.
Got it, sir. I'm sorry, we have been asking a lot of questions. I
Yeah.
know we're a little overdue already. Over to you, sir, towards the last part.
Sure. Yeah. Yeah. I'm pretty much at the last couple of slides. So I just want to maybe conclude and give you some key takeaways, right? So
Yeah.
I think this is something that I've been saying through the presentation. There's no right or wrong way to do ESG. I think depending on your end goal, you could choose one or more of those approaches. I think what is very important is to be very transparent and clear about what your approach is, right? You don't want somebody to kind of pinpoint fingers at you and say, boss, you're just greenwashing or you're just kind of faffing. You're not really doing what you're saying you're doing. So whatever you're doing, be transparent about it. And then obviously, if you want to improve, you will do it over time. It won't happen on day one always. Um, the materiality of financial materiality of ESG risk is no longer a developed market or a Western concept. I think it is playing out in our market, and I've given you enough examples on that. And then I think for the more mature managers who've been doing ESG for a few years, we are very clearly seeing a shift from broad ESG ratings and scores to very focused KPIs or themes that they are looking at. So carbon is very important. I think human rights and labor practices is another thing that's very, very relevant. Biodiversity is a more upcoming issue. So you see basically preference for certain KPIs or themes that we'll focus on rather than we'll like merge together 100 different things into one rating and then use that rating to filter in or filter out companies. So that is the way the field is evolving, not just here in India, but also I think globally. Uh, how can investors kind of structure their ESG efforts? And this is my last slide. What I feel is very important is it should be integrated into your thought process upfront rather than an afterthought. I think that is the right way to do it, and everybody will have their own kind of what I would say as maturity scale, right? So you might not be able to do it on day one. At day one, you might just say, let's screen out a couple of sectors, and that is my ESG approach. On day two, year two, you might say, let's look at a score, whether it's third party or our own. In year three, you might say, let's start thinking about this when the analyst is actually making their assumptions for a particular financial model rather than as an exposed thing, right? So that is something that's very important. Engagement is a very important way to convey to corporates that this is something that I'm paying attention to, and this is something I want you to improve. Uh, Building capacity, and this is something that we need to do a lot more of in India now. Webinars like this is basically my way of contributing to this, is basically spreading the word, generating more interest, building capacity amongst not just the ESG specialists or practitioners, but also amongst the broader investment analyst community. I think it's very important. The way I see this evolve, and hopefully we get there sooner than later, is ESG doesn't become a specialized subject, become basically day-to-day knowledge for every single analyst. So whether you're an auto analyst or a utility analyst or a steel analyst, you would be able to basically assess some of these risks yourself in your day-to-day analysis rather than rely on ESG specialists to tell you what's good and what's not. And there are obviously a lot of certifications available. The more popular ones are from the CFA Institute, but there are others as well in the market which will help you get there faster. Um, and then I think very important that this is something that is a top-down effort. We are lucky at DSP that our senior management is supportive of these, and it makes my job a little easier, both on the investment side, but also on the corporate side. I think the senior management support is very, very important to do this because bottom up, you could do it in a few companies in one fund. But if you want to do it more structurally, I think that is something which is very, very important. That's all from my side. This was my prepared remarks. Happy to take any last burning questions that I think we are over time, so I would also be conscious of that as well. Sorry, you're on mute, Shailesh.
Oh, sorry. So I'm really sorry. I know we are overdue, but just one last question. A piece of advice to these young candidates who are trying to get into the domain of investment management and investment
Mhm.
research roles. So, a piece of advice based on your extensive experience in this industry.
Uh, in terms of building a career,
Yes, sir.
yeah, so I think, I mean, see, when I started on this space 15, 16 years back, there was a need for specialization. There was a need for ESG specialists. I think if I'm a 20-year-old getting into this today, I would not just be an ESG guy. I would probably be a financial analyst who also has an understanding of ESG rather than just a ESG specialist. Right? That would be my key advice. Like I said, I see the way I see this field evolving, and it's already happened in some foreign markets where mainstream analysts are understanding how to kind of evaluate these issues on a day-to-day basis and integrating that into their day-to-day workflows rather than just rely on the ESG specialists. So in India, there's a few more years till we get there, but that is how I would kind of approach it if I'm kind of a fresh graduate trying to get into the space.
Got it, sir. Thank you so much. I know we have been bugging you a long time for this guest session, and we're really happy. And I'm personally very glad that you gave us this opportunity for our students to learn from you. It really means a lot to us, and I hope you keep us blessing with the same support in future as well. Thank you so much once again, sir, for taking out time on your calendar and for this opportunity.
Thanks, Alish, and I hope it was helpful and useful exercise. Yeah, happy to share.
Definitely, sir. Thank you so much, sir.
All right, thank you. Bye.